In this video, I will show you 3 easy ways to analyze a stock based on its financial statements. This is part 2 of a 5-part series on how to analyze a stock. I'm Greg Kilpack, president of MarketTimingUniversity.com. Now, analyzing financial statements can get complicated pretty fast. So I'm going to show you how to do it. You don't have to have an accounting background to understand this. The basic principles are simple and easy, so you don't need to feel overwhelmed if you don't have an accounting background. You can still do this, all right? So don't worry. Now, there are many different kinds of financial statements, including the income statement, the balance sheet, the statement of cash flows, and others. The most important one that we need to look at is the income statement. A stock's price is based on how much money the company is making in terms of revenue and then earnings. How much are they keeping? That all can be found on the income statement. So that's the most important one to look at. Now I want to look at McDonald's. And here's the annual income statement for McDonald's. You can see that this shows information for the last 3 years for McDonald's on their sales and earnings and their expenses. Excuse me. So the first thing you want to look at on these income statements would be, are revenues and earnings growing consistently, or is it volatile? For McDonald's, let's look at that. In 2010, McDonald's brought in $24 billion right there. In 2011, they brought in $27 billion right there. And in last year, they brought in $27.5 billion right there. So that's what they brought in terms of sales. Let's look at earnings. Down here, net income is the same as earnings or profits. 2010, they brought in under $5 billion. 2011, it was $5.5 billion. And in 2012, they're at about $5.5 billion still. There's a slight drop there, but it probably doesn't matter too much because McDonald's is a pretty stable company. So we can see that this is pretty stable and steady growth in earnings and revenue. All right. Let's look at the price chart real quick and see if the chart matches that. It should. We're investors, so we want to look at the big picture, the 5-year chart. You can see that revenue and earnings have shown up in the price chart. The stock has steadily climbed over the last 5 years from around $50 a share to around $100 a share. We had a 15% pullback last year. It's pretty typical, not unusual at all, and we're back up to close to $100 a share. So this fits what we're seeing on the income statement. Let's go to a very different stock. Let's go to Netflix, which is a growth stock compared to McDonald's, which is a blue chip stock. Over the last 5 years, we've seen big ups and then a big down here and a big up again back with Netflix. Netflix was growing very fast. Then they did some missteps, came all the way back down, and are trying to fix that and are starting to go back up again. Okay, so obviously very volatile stock. Let's see what the income statement says about Netflix. We are looking at the annual income statement again for Netflix. In 2010, they had $2.1 billion in revenue. That's why they were still growing very fast. Up to 2011, in 1 year, they had more than a 50% increase in revenue from 1 year. That's really fast growth. And in 2012, last year, they had a slight increase in sales. So what's going on here? It's slowing down quite a bit in terms of revenue. Let's go down to earnings and see what's going on. And that's where we see the real picture. From 2010, we've got $160 million in profits. 2011, it went up to $226. That's pretty fast growth. Still, the end of 2011 is where they made their mistakes and their missteps. And it cost them in their earnings in 2012. Okay? They only had $17 million in profits in 2012. So obviously Netflix is a volatile stock. Any growth stock that fails to hit their numbers and fails to grow as fast as they were growing, they're going to take a big hit just like Netflix did. So you have to be aware of that if you're buying growth stocks. Okay, so the first thing is, are revenues and earnings growing consistently or are they volatile? Well, Netflix was consistently growing fast, but as soon as it's not growing fast, it's going to take a big hit. Whereas we know that everyone is going to keep buying Big Macs forever at a pretty regular rate, and that's why McDonald's is growing pretty consistently and stably. All right. The second thing is the rate of growth holding steady, or is it increasing or decreasing? If a company fails to grow as fast as it had been, that's a warning sign. And we saw that in Netflix. Whereas we know just from using common sense that McDonald's is going to keep selling more Big Macs as the U.S. population grows over time, unless something happens. Okay, so McDonald's is a much more stable company, obviously, than Netflix. The third thing we want to look at is what I've been showing you. Does the price chart match the financials? Let's go back to the price chart for Netflix. Now, the angle of the climb should match how fast the company is growing, and that's what we saw in Netflix. As soon as there's a threat to that and you see a big sell-off, even right here at $250 a share, I would have sold based on that news if I wasn't out already, because that's a big trouble sign. When big news comes out like that could threaten the entire revenue of the company, boy, that's trouble. And so that's your sign right there to get out. And we can see that the stock went all the way down to about $60 a share. So need to keep an eye on revenues and earnings at all times, especially if you're in a growth stock like Netflix instead of a more stable stock like McDonald's. Now, consider the risk here. McDonald's doubled over the last 5 years. That's good. Over the last 5 years, Netflix went from about look right here, from about $20 a share to $300, more than 10 times your return inside of about 3 years. But then, at the wrong time, it took a big hit and came way back down. So you can make a lot of money in growth stocks, but you can also lose a lot if you don't watch it closely, don't manage it carefully, and don't get out when bad news comes out. So just something to be aware of when you're looking at stocks. I'm going to talk more about the different types of stocks you want to buy in a future episode of this series. In fact, probably the next one. So look for that. Okay, this is Greg Kilpack, and I invite you to come to my website to read my blog on a regular basis, markettiminguniversity.com. Scroll to the bottom of the front page and sign up for your free document on how to earn greater profits in the stock market. Hope you're having a great day, and I hope this episode helped you out a lot. Thank you for joining us, and we'll talk to you soon.